Welcome to Investors Insights, where today's topic is numbers behind the noise. So before I give an update on where valuations stand, Ty is going to talk about CapEx slowing down, which is important. But first, Trey, tax deadline has passed, tax revenue is up this year, and the Treasury General account has been replenished. So tell us why that matters.
Yeah, thanks, Bobby. So for people that have been watching our vlogs consistently, they know we've been talking about the Treasury General account since January. It's something that's an important driver of liquidity, and that's just money in the system. Why is that? So every month, the U.S. government takes in money from tax receipts and then borrows money that they need to then pay out all the benefits the U.S. government pays out. And so in January, we hit the debt ceiling, which means that they can no longer borrow more money. So they're still bringing in tax receipts, but they're paying out at the same level. And so each month we pay out more than we bring in. And so how can they do that without borrowing? Well, they spend down the general account, which is the Treasury savings account. And that's money that's been printed and created that is outside the banking system. And so when they're spending it down, that's putting new money into the system, and it is relatively stimulative. It usually puts downward pressure on bond rates, puts upward pressure on stocks. And so we saw that at the beginning of the year. The Treasury General account went from around $840 billion down to $280 billion. And then it flatlined in late March. You can see on this chart where it flatlined. And then now that people are paying their taxes, that's money coming out of the banking system, coming from me and you, and going into the Treasury General account. So that's money leaving the system. And so we've seen $358 billion swing back into the Treasury General account. So that's a net liquidity negative. So that should put downward pressure on, we've seen it, in addition to tariffs, this is also a driving force, downward pressure on stocks and upward pressure on interest rates. This is good, though, because the money's come in roughly $200 billion above where it was last year. So we're bringing in more money. And we initially thought that the Treasury General account would run out around August. So as long as there's the federal government has this savings account, they continue to spend without Congress raising the debt ceiling. Original estimates were around August. So this higher tax receipts we thought could extend that deadline. The trouble is, if you look on this chart, this shows the year-over-year federal spending compared to previous years. And while there's been a lot of talk about massive spending cuts of the federal government, the numbers don't play that out. Spending is actually $200 billion ahead of this time last year. So far, while tax revenues are up, spending is up equally, if not a little bit more. And so the general account may actually be spent down faster. That's something that's not a problem today. Today, we're focusing on tax receipts being that big boon to general account and the huge liquidity suck out of the U.S. economy. But in the long run, when we're getting into the summer, this is going to be an important factor. How high do tax receipts take the general account, then how quickly is it spent down? Because that's kind of the timeline that Congress has to pass tax reform. They have this as long as there's money in the general account, they don't have to pass a spending bill. But once this general account hits zero, action has to be taken. And so the speed of this spend down, now that we've replenished it, is going to be something we're watching very, very closely.
Yeah, so it matters. We're watching spending and the deficit very closely here. Another thing we're watching closely is we've been talking about the higher valuations concerns in the market really since last year. So I wanted to give an update to our viewers on where the market stands after the market pullback this year. So as you can see in this first chart, the NTMPE, or the next 12 months price to earnings ratio, is showing the S&P 500 has come down in valuation to 17.9%. Which is actually still higher than the average there that you can see on the line, 15.9, going back to 1996. So we look at this valuation metric because it uses the company's projected earnings per share for the next 12 months in the PE calculation. And this helps provide investors with a perspective on the company's future earnings and then also the company's potential growth. So while valuations have come down in recent weeks, the market is still above historical norms. And so we'll continue to follow valuations closely here to see how the market might perform for the rest of this year. And then Ty, CapEx is slowing down. Tell us why this matters.
So, we always want to keep an eye on capital expenditures or CapEx. And so we have some surveys from the CEOs from January, March, and now April numbers have come out. And it's been a steady decrease. Now, we like to see capital expenditures kind of increase because that signals, business confidence, that signals maybe increasing demand. There are various reasons, CapEx can expand, but for the most part, it's kind of correlated a little bit with demand forecast. And so when CEOs are confident that demand forecasts are going to be good, they will, be willing to spend more to produce more goods. Well, in January, 56% of CEOs expected an increase in CapEx for 12 months out. Then in March, that number went down to 36%. With April's numbers, we are down to 26%, with 41% expecting that they actually decrease capital expenditures 12 months out. These are numbers that we're certainly going to keep an eye on as CEO kind of business confidence has gone down a little bit. What could be kind of a lifeline for these companies? What could be beneficial for them is the tax bill that we have referenced before. So of course, TCJA is on track to expire at the end of the year, but we are hoping that TCJA is not only extended, but also there are some new provisions in a tax bill with some of the additional revenue that came across from the tariffs. And so some of the perks of the tax bill may look like R&D expensing expenditures more rapidly. So in 2022, companies were having to amortize their R&D expenses over 5 years, and we're looking at maybe the odds of domestic expenditures for R&D being amortized immediately instead, or being realized immediately, possibly reinstating a bonus depreciation, and then maybe looking at some different ways of accelerating depreciation for facilities instead of writing it off over a longer period of time, maybe being able to write it off immediately. Because remember that, again, the whole point of the tariff negotiations is to bring manufacturing here. And so you kind of hurt them on this side of saying, hey, don't do any kind of manufacturing overseas, but then you got to throw them a carrot over here as well and talk about, another perk of bringing onshore. And so that's something we're going to look at, and hopefully some of this stuff can get across the finish line sooner rather than later.
Yeah, so a lot to cover this week. If you have questions, email us, call us. We'd love to hear from you. Have a great week. Thanks.